Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today I have a quick update for you guys, copiers of the eToro portfolio. You'll have noticed that we had a very good month in October, and hopefully you're starting to get the understanding of the idea of being a value and contrarian investor does involve a little bit of patience. It involves a lot of diligence and some stomach in the way of volatility. And so volatility at the moment is working to our upside, and it has also worked to the downside. Plenty more of that to come. Speaking of volatility, we have a very volatile position that I'm going to go over. We're going to quickly address the initial thesis and where I think we're at in terms of this particular position from a macro and a micro perspective. I'm going to give an update on StoneCo, the Brazilian fintech, our second Brazilian equity position in the publicly available portfolio. Disclaimer, guys, I am not your financial advisor. Don't know you from a bar of soap. So please take everything you see here just as a grain of salt. Anything that you hear me say on the internet in general, but particularly on this channel, is purely my opinion, and what I'm doing doesn't make it right, doesn't make it right for you necessarily. Okay, my means may be very different to yours. This is just my opinion, what I'm doing with my personal money and the funds that I manage. That's it. Okay, nothing is to be considered advice or solicitation to any specific course of action. One page macro as of October. Now, I've done the energy sector to death. So today, just a few quick points as they pertain particularly to StoneCo in terms of a macro perspective. So inflation is secular, not transitory. I've been saying that for 2 years. Everyone, I guess, with half a brain has known that and known not to believe the powers that be when they were calling for inflation to be transitory. We have some geographical considerations when it comes to this. So this is something that I have really been pondering deeply ever since I spoke in depth with Emmanuel Dat around the idea that certain beta in sectors will lead to a lot of your outperformance, and the alpha is more to do with relative asset selection in that beta class, or put maybe more simply, any industry that is going through a bull market is going to contribute most to your overall returns. And so any alpha above and beyond the performance that that particular sector has comes down to your asset allocation in terms of specific equities. So when it comes to geographical considerations, I think now more than probably ever, it's really important to consider countries, currencies. And so what do I mean by that is if you look at countries with strong energy reserves and strong net foreign exchange reserves, I think that's hugely, hugely important. And it's something that perhaps I did not consider to be quite as important going back maybe 6 months to a year ago. We've seen what happened in Great Britain with the pound. Those guys have basically no energy reserves and no foreign exchange. They have to import everything, and they just got absolutely crushed. When we're in an environment where the US wants to raise interest rates, Great Britain really have paid the price for that. And I personally got smacked with my position in Royal Mail. I had already previously exited Glencore. And so it's just so important to consider not just the bottom-up fundamentals on the returns of a particular investment, but what currency those returns are going to be denominated. And that's hugely, hugely important. So for now, I am looking for countries with strong energy, either independence or ability to export, hopefully. That will help prop up their own currency. And in addition to that, I'm looking for relatively unindebted nations who have net foreign exchange balance, so that if their currency comes under pressure from rising interest rates offshore, then they will be able to hold steady with their own energy production, but also be able to sell down some of their foreign reserves in order to buy to prop up their currencies, essentially. US dollar has smashed most emerging markets and developing markets. The Aussie dollar and the pound have really been hammered this year. Interestingly enough, the Mexican peso and the Brazilian real have not declined to the degree that people would normally expect. In fact, the real has actually strengthened slightly recently. So the question is, are there going to be bargains for early birds who can see through some of this clutter and mess? And eventually, if we're expecting the Fed to have to pivot or at least pause due to balance of payment issues in the US, meaning they can't raise rates too much past maybe that 5% federal funds rate, because otherwise they won't be able to service their debt. Then all of a sudden, if we're able to get in early and hang on to the volatility, it will be gut wrenching when that US dollar trend starts to mean revert, or at least retrace. We're going to get a double whammy. We're going to get growth in sales from an emerging market asset, and we're also going to have strengthening of that sales due to their currency strengthening relatively. Capital unintensive, clip the ticket style business models. I've spoken about this before. It's going to be super important coming into an inflationary environment. I don't particularly care what sector they're in. Energy is simply the best bet at the moment due to its demand inelasticity and the lack of supply. So that's why I've spoken so much about it. But the idea from a royalty or streaming type model of being able to have a percentage upside of revenue without a step function increase in the expense column allows you to grow margins over time and protect you from inflationary pressures in that expense column. Okay, so let's take a look at the Bolsa and relative to S&P 500. So we are obviously at super low levels in terms of how many units of the S&P it would take to buy a unit of the Bolsa. And we're about where we were at prior to COVID, back at 2016 levels. Okay, so relatively speaking, based on this chart alone, one would quite reasonably expect Brazilian equities as a whole to be relatively undervalued versus US equities, at least on this historic basis. If you wanted to be a technical guy and to chart that out, that descending wedge there looks like we're starting to get a little bit of a breakthrough. It's just popping its head out of that trend line, and it'll be interesting to see what happens. If we move me out of the way there, US dollar currency index. This is the DXY, the DXY, and this is purely a measure of the US dollar's relative strength to a basket of other currencies. It doesn't mean the dollar's any good, okay? It's as ratchet as everything else, but it's all a game of comparisons, right? So you'll notice we go all the way back here to end of 84 when Paul Volcker took Fed funds rate through the roof in order to be able to combat inflation. They cannot do that again because the balance of payment issues are way different. From here, as you can see, every time they've had an increase in rates, we have an increase, but it's a lot lower to that initial point of reference. And every time they've tried, if we go to 2018, the market threw a tantrum and Jerome Powell had to make his famous Powell pivot. So we have broken through that previous resistance line with the DXY at 110. And I want to point this out because listening to Jeffrey Goodlack recently, he's expecting shorter term increase in dollar strength, as am I, if the Fed is serious about getting to that 4 or 5 terminal funds rate on the FFR, then we would expect a little bit of an increase again. It could go to 120, but I think we're closer to the top than we are the bottom. So don't misinterpret me. I do expect further strengthening. However, I think we're closer to the top than we are the bottom, given how close we are to reaching that terminal rate expected by the market. One thing Jeff said that I thought was very interesting is he's looking to go long into emerging markets when you have the DXY return to its 200-day moving average. So this dark blue line here, should we retest that and burst through it, that might be considered a good entry signal in terms of upping the weighting to emerging markets. So that's his perspective. I thought it was interesting. I thought I'd share it. Okay, so if we go in on a shorter time frame, this is over the last year, still the DXY index. You can see where we're at, 110. The 200-day moving average over the last year is a little over 105, let's call it. So if we were to start to retest here, I would look to perhaps move some capital around and increase my weighting to the 3 Brazilian equities that we hold. So we have Petrobras, obviously, is the number one, the big one for many, many reasons. StoneCo, which we're going to talk about more today, and National Steel Company of Brazil. Okay. All right. This is a measure of the bond indices, Brazilian 10 years versus the US 10 years on nominal pricing. And as you can see, the Brazilian bonds trade extremely cheaply relative to the 10-year at the moment. So interesting. I think that makes perfect sense. US raising rates, capital leaving emerging markets or leaving the euro dollar system and repatriating back to the US by various means. That means more people are interested in holding 10-year notes than they were before. Eventually, if we see these interest rates start to cool off a little bit, the bond prices will strengthen, and people may look to emerging markets with strong FX and energy independence, or at least a very strong energy position, such as Brazil. So you may see this start to revert, and Brazilian bonds might strengthen in terms of nominal prices. Okay, currency. This is the big one. So USD versus the real. We're not at all-time highs over the last 5 years, but we're certainly on the upper end, and so I would expect that to start to soften a little bit back to where we were, maybe around the 4.5, so 4.5 units of reais to purchase at 1 unit of USD. And that will just simply provide more tailwinds to the earnings of this company. So here's the micro overview for StoneCo as of the end of October, as I'm recording this now. End of this year, the company is expected to do 1.76 billion US in revenue, 803 mil in EBITDA, and the free cash flow, analysts estimate at 361 million. The company had a big interruption in terms of COVID, and I think that now the wind is really in the sails for this particular company. Enterprise value of 3.2 billion gives us a cash flow at the moment of 11% yield. Its mean multiple, very, very difficult to guess because it's not a very old company, okay? So it's only been around for a few years. I'm going to say that you could reasonably, given the strength of this business, given the market prospects, I mean, Brazil is a hugely promising emerging market where many people don't even have cell phones yet, let alone bank accounts. So a fintech company who is capital light that can have a huge runway for growth, which it does, not only in the saturation of the fintech market, but the population growth, and then the growth of that population hitting their S curve in terms of income. I think that they're in a wonderful, wonderful position from a growth runway perspective. Given the quality of their earnings, I believe that they can grow their earnings at a massive rate without growing their expense column to the same rate. And so I'm going to say that an 8% yield is fairly reasonable across most of these guys. So I don't know if you'd agree with that or not, but that's why I've got the 12.5 mean multiple. But as I said, time will tell. Net debt position, 99 mil, shares on issue, 312 mil, current price as of recording, $10.17. Book value 2.42, return on equity over the last quarter was 18%. A little bit difficult to read here because during COVID, obviously things were all over the place, but that's a very, very good quarterly return on equity. Very impressive indeed. And this is the big one for me personally, the quality of their earnings, 44% free cash flow margin. So for every dollar of sales on the top line, the company can get 44 cents free and clear to be able to use as they wish. This is a very, very, very good margin. This is essentially a royalty type business, just in fintech. So let's look at the pricing. So 2021, they had some issues with an acquisition. They had some negative press, and it's down 90% peak to trough. This is where, if nothing has changed from the initial theses surrounding the company, this is where I get very, very, very excited. Talking with Bull Cycles on Twitter, fund manager in Singapore, very, very astute guy when it comes to this type of thing. He is maniacal about when you can buy something at 5% discount to its NPV, you are looking at a multi-bagger, provided your thesis is correct. And I think that this is one of those cases. Could it go back to above $90? This was a fairly loose liquidity environment here. But why not? I mean, I don't know why not. This is a wonderful company. Their growth is set to do double digits, and the quality of their earnings is very, very good. So who knows? It'll be interesting to see. Okay, let me try and find a clearer picture. So using Koifin here to bring up some of the most pertinent details from I guess, a balance sheet perspective in terms of the valuation. So we're currently looking at the company. I'm looking at the company at 3.3 times next year's EBITDA. Okay, so that is not expensive. Not expensive at all. Find me another fintech with this type of quality of earnings that's trading at 3 times its EBITDA. I'd be very interested to know. Send me an email. Market cap 3.18 bill. Shares outstanding, as I mentioned, and the net debt 336 mil. Okay, on the EBITDA of 800, that's very, very, very comfortable. It also has 800 mil in cash on the balance sheet. That's not net cash. It's just pure cash that they can use to service debt, buy back shares, pay dividends, acquire other companies, do all sorts of things. So it's very, very handy. That's a huge percentage of the market cap in cash, nearly 30% market cap in cash on the balance sheet. And to give you an idea of the income and cash flow, cash from operations for the last 12 months, which will be quite poor, we'd expect, with Brazil going through some issues in terms of COVID and whatnot. Don't forget they have an election that should be finalized by the end of the year, which I think is why the uncertainty of the market is leading for the share price to be undervalued, in my opinion. Cash flow from operation, $750 million, let's call it. Okay, 742 million. Out of that, look at the difference. The capex is very, very small for mine. And out of that, a bit over 20% cash flow from operation goes back into the running of the business. And I think a lot of this is to build up their infrastructure. I expect that percentage to actually come down over time, because once they've set up their infrastructure, they really don't need to spend anything else other than perhaps STNE expenses for marketing. Free cash flow, very, very good. Obviously, a huge chunk of that cash from operations goes into free cash flow. Market cap we've seen, and cash on the balance sheet we have seen. So let's take a look. Here are the base, the bull, and the bear case in terms of the valuation. Some things here, because it is a Brazilian company, I need to point out. So terminal multiples, obviously up to you what you want to choose. I have looked at what I think is reasonable versus competitors. The growth rate. So I have used actually quite a conservative growth rate compared to most analysts. Most analysts have this growing at least at 30% over the next few years, which is quite reasonable given that we're tapping into a previously untapped market. However, the discount rate in this case needs to be high. It needs to be the weighted average cost of capital, and it also needs to take into account the fact that this company is earning in a weaker currency. So what are we going to add to our discount rate in order to handicap or to fairly weight the real versus if it were earning in US dollars, for instance? So what I've chosen to do is follow Aswath Damodaran's research. If you read the article that I've mentioned here many times before, WACC, weighted average cost of capital, the Swiss Army knife of finance, you'll understand where I'm coming from with this. So I've taken the weighted average cost of capital, which is from memory 16%. And then I have added a premium using the 10-year bond. So the Brazilian 10-year bond, which is around 11% yield. So this is just what I have done. I'm not saying it's the only way or the right way to do it, but I really want to be able to discount that risk of the currency. And so adding those together, we're getting 27% as a discount rate, which is huge. However, as you'll see, that provides a nice margin of safety, and the company still looks to be fairly good from a valuation perspective. So we've got a base case, a bull case, and our bear case. These are the cash flows expected to produce. I've done an EBITDA and a free cash flow and weighted them between the two. Here you'll have, according to this model, an intrinsic value of around $18.55 US. If we take a 2/3 margin of safety on top of that, we look to buy the shares below $12.24. Would represent reasonable value if all the inputs here do come to pass. And so to me, $10.17 is a very good opportunity. The average entry is just around $15. So we're still doing okay, considering its intrinsic valuation. And if the company were to drop even further, I'd continue to scale in. I just think there's going to be a lot more in the way of selling pressure, given the Fed's insistence on raising rates, until probably, my guess as to when we start to see rhetoric change might be the first quarter of 2023. That's my guess, but I'll be keeping an eye on that US dollar index. Okay, so from a broad perspective on the valuation, I've mentioned everything else there in terms of the inputs, really. This takes into account the equity and enterprise value on the balance sheet. And so here, if we do take that extra cash into consideration, using conservative growth estimates for the EBIT, this is suggesting a higher valuation of around $27.55. Our entry price is lower than that since I bought a little bit more last week. So it's around $15. Our IRR is still expected to be healthy in the mid 30s. Okay, so very, very happy with that. You're essentially expected to double your investment every 2 years, roughly, if you've got a 30% IRR. So very, very happy with that. And I think that without taking the bear case into account here, just use the base case. I think it's pretty safe to say I'm very happy with the investment, regardless of what happens in the medium term. Okay, IRR time. So internal rate of return calculations on a per share basis for the base case cash flows. So you can refer to the previous chart. Using the finance rate, which I've explained now why that's so damn high at 27%. And I've said here, I haven't even given a compounding consideration. I've given this reinvestment rate as 11%. What I'm saying here is we're taking the cash flows, and if we just reinvested them in Brazilian government bonds, which I personally wouldn't do, I'd reinvest it back into the company at that 27%, which would be the discount rate. However, be that as it may, I think that this adds another layer of safety to the valuation. So we're looking at a pure IRR of 30%, which is very, very good on an annualized basis. And it does fit in with what we've seen before in terms of that expected IRR of around about 30 odd percent with an average entry price of 15. And here, purely using the cash flows and ignoring the cash that's already on the balance sheet, entering at a lower price today gets us pretty close to that as well. So I think things are all heading in the right direction in terms of telling us at least a consistent story. So the verdict is a buy. I have upped my potential allocation for the company. I was keeping it at 1.5% of AUM. I would be looking to double that potentially if I found the right opportunity. If we got a sell off and it was just too good to ignore, I'd be looking to really scale in. I'm nibbling at the moment. The company has a low debt, it has a great margin of safety. It's got sales growth for days. The margins are there. The free cash flow growth is there. The share buybacks have not been present yet. But as this company starts to build up a mountain of cash, that makes the most sense moving forwards. Once they have built out their infrastructure, there's nothing else that needs to be spent. And so there will be a capital unintensive, clip the ticket type business where their sales will grow and their expenses will not grow at the same rate. And the difference between the two will be an increased margin and an inflation protected business is my thesis. So I hope you like that, guys. Time for a little plug for the ROI Club. That is my private membership on Substack. It's a regular publication for an astute group of private investors. I love everyone in there at the moment. We've just had an absolute blast. Everyone seems to be very happy with the content. So that obviously makes me very proud. What you get some free publications that anyone can just have a free membership. That's fine. But the exclusive stuff, you get access to my in-depth stock analyses. Every month I write an article that is the month in the review and the month ahead. And I go through one particular stock that I'm very interested in, and I do a deep dive in terms of its valuation. I share exclusive interviews with other professional investors. I'm very blessed to be able to contact these very smart people. You get access to my intelligence nodes. So all the money that I spend on software, my personal contact sphere, all of that comes in, and I pass along that information to you, which is worth the price alone. You get a master valuation sheet of companies that I'm following that's automatically updated. And obviously you can ask questions, make requests. And if you're interested in options, I have a lot of option strategies that I share with you. I share what I'm doing and why I'm doing it. And so far those have worked out pretty well. It's $10 a month if you just want to pay monthly and get a taste, or if you just want to pay up front it works out to be $5 a month. Okay, so $60 up front, and you get access for a whole year. It's not expensive, guys. The value that you get, you'll make it back in no time, or at least so far the current investors have, for sure. So I'll leave a link in the description. Please do check it out, and I'd be very honored if you were to join the club. And other messages, if you're interested in simply copying my moves on eToro, you can check out the link and you can copy the portfolio there. I'm on Twitter if you want to hit me up. And obviously, if you do enjoy these videos, please like and subscribe. It helps to grow the channel. Having said that, I look forward to seeing you in the next video. Take care, guys. We'll speak soon.